If you search for an S&P 500 ETF in Europe, you will see dozens of options that all look almost identical. Same index, same companies, often even the same past performance on the chart. But underneath, these ETFs can behave very differently once currency, taxes and structure come into play. That's why many European investors end up underperforming the index without ever realizing they picked the wrong version. The problem, isn't the S&P 500 ETF. The problem is choosing the ETF without understanding what actually matters. In this video, I'll break this down into 5 clear checks you can use to compare any S&P 500 ETF in Europe regardless of provider or currency. By the end, you will know exactly what to look for, what to ignore, and how to avoid the most common mistakes that quietly hurt long-term returns. You see, this is what actually matters when choosing the S&P 500 ETF in Europe. Not which S&P 500 ETF is the best one. Choose the right one that is right for you and for European investors. Because the wrong structure can quietly bleed returns. The wrong currency setup can mess with your psychology. This is what happened to a lot of people in 2025 when the dollar collapsed compared to the euro. And the wrong tax treatment can undo years and years of compounding. This matters today because more brokers than ever are pushing for cheap-looking ETFs without explaining the trade-offs. And most beginners assume cheaper always means better. That assumption is often wrong. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences every single year in Central Europe. And if you want to see more videos like this, hit that subscribe button. Let's start with the first and most misunderstood check: how the ETF actually tracks the index. This is called replication method. There are 3 main types you will see in Europe: physical, aka full replication, physical sampling, and synthetic replication using swaps. Let's see the different ones. Imagine the S&P 500 as a, let's say, shopping list of 500 companies. A physical full replication ETF literally goes out and buys all 500 stocks in the correct weight. When the weights change, so does the ETF. Every quarter, a company who's responsible for maintaining the S&P 500 index, they make tiny adjustments, sometimes a little bit bigger. Which company's stock price went up drastically in the last quarter, and which company went, for example, bankrupt. Those that went bankrupt have to be dropped from the index, obviously, and replaced with new companies, because the index always have to reflect the 500 largest companies in the US. A classic example here is the iShares S&P 500 accumulating ETF with a total expenses ratio of 0.07% and over about 100 billion euros in assets. It simply owns the shares, nothing fancy. Next one, sampling. Sometimes you see optimized sampling is literally the same. Sampling means the ETF owns most but not all of the index, using optimization to cut costs. To buy or sell 500 companies, it is a costly matter, and what if you could achieve the same results with buying and selling, let's say, only 200? That's what sampling is. Third one, synthetic replication is different. The fund doesn't necessarily own the shares at all. Instead, it uses swap agreements with banks to receive the index return. In Europe, this structure is common and regulated under UCITS rules, and funds like popular, let's say, Invesco S&P 500 ETF use it, with extremely low headline costs, around 0.05% per year. Here's the twist. Synthetic does not automatically mean bad. In fact, some synthetic ETFs track the index more precisely after costs. But you are taking counterparty risk, even if it's limited by regulation. For most long-term investors, physical full replication is the simplest and easiest to understand. If you ever find yourself unable to explain how your ETF works to a friend, that's a warning sign. That's why I always preferred a simple physical ETF. The second check is accumulating versus distributing. This one sounds boring, but it has huge long-term consequences. Accumulating ETFs reinvest dividends automatically inside the fund. Distributing ETFs pay them out to your account, usually quarterly. If you are in your 20s, 30s or 40s and building wealth, accumulating is almost always superior. Why? Because reinvesting happens without any friction, no temptation to spend, no manual reinvesting. And in many European countries, better tax efficiency. For example, in an accumulating ETF, like the SPDR's low-cost version, around 0.03% annual charges, quietly compounds every dividend back into the fund. Over 20 or 30 years, the difference is enormous. Distributing ETFs makes sense if you need some income. Think, for example, if you retired or people funding part of their lifestyle. A Vanguard S&P 500 distributing ETF is a classic choice here. Pays dividends every single quarter. But be honest with yourself. If you don't actually need the cash distributions, it slows down compounding. Many investors choose distributing ETFs simply because it feels good to receive some money, isn't it? Even though it hurts long-term results. So make sure that you keep an eye on that. Third check, currency exposure. And this is where most Europeans get confused. The S&P 500 is priced in dollars. That means you're always exposed to the dollar, regardless of whether you buy the ETF in euro, pound, Swiss franc, whatever. Let me repeat that. Trading currency is not the same as exposure currency. You can buy a dollar-based S&P 500 ETF on a European exchange in euros. You haven't removed currency risk. You just changed the checkout currency. If the dollar weakens against the euro, your investment falls even if the S&P 500 goes up. Now, you do have a choice. It's called unhedged or hedged. Unhedged is cheaper and simpler. Most long-term investors should accept currency fluctuations as part of the journey. Over decades, currency effects tend to even out, and the dollar often acts as a diversifier. Hedged ETFs remove dollar exposure but cost more. For example, a euro hedged S&P 500 ETF might charge 0.2% per year instead of 0.05 or 0.07. That difference compounds. Hedging can make sense if you are close to retirement or want lower volatility in euro terms. But long-term growth so far, unhedged one. But if you want complete peace of mind, especially in these volatile times when the dollar is really moving, hedged euro version might be better. I actually started buying the hedged version. This means I don't have to worry about the dollar declining further. I will go back to buying unhedged versions of the ETF when the currency markets calm down a little bit. Fourth check, costs. And yes, fees matter. But not in the way most people think. The total expense ratio is deducted daily from the fund. You never see a bill. A difference between 0.03 and 0.07% sounds tiny, but over 30 years it can add up. That said, obsessing over the lowest TER alone is a mistake. A synthetic ETF with ultra-low fees that consistently underperforms the index after swaps and costs is worse than a slightly more expensive physical ETF that tracks well. Costs are a tool, not the decision itself. If you bought, let's say, a hedged euro version of the S&P 500 in 2025, your costs were 15 basis points higher, but your returns were 8-9% higher. Which brings us to the fifth and most important check, tracking difference. This is the gap between the ETF's return and the actual index return. This is what you should care about the most. If the S&P 500 returns 10%, your ETF returns, let's say 9.5%, the gap is your real cost. It includes tier, trading costs, taxes inside a fund, and the replication efficiency. Two ETFs can have the same TER with very different tracking. Always look at historical tracking difference, not just the fee itself. Let's bring this together with a real-world example. Imagine two European investors. Anna buys the iShares physical accumulating S&P 500 ETF in euros, so unhedged version, with a TER of 0.07%. She never touches it. Ben buys the Invesco synthetic ETF with 0.05% annual charges, trades it in euros, switches between accumulating and distributing over time, and panics when the dollar falls. On paper, Ben picked the cheaper fund. In reality, Anna very likely ends up with higher returns because she stayed invested, avoided unnecessary trading costs and trading, and let compounding do its work. There are also tax considerations you must not ignore. In the UK, for example, holding ETFs inside an ISA means dividends and capital gains are tax-free up to the annual £20,000 allowance. In Hungary, for example, the TBS structure can eliminate tax entirely if you hold it long enough, 5 years. In Slovakia, ETFs held over 1 year can be tax-free. In Belgium, for example, there's a 10% tax with an annual exemption. The same ETF can produce very different outcomes depending on where and how you hold it. So structure beats cleverness. So after having all these 5 checks, what should you actually do? If you are a long-term European investor building wealth, a physical, accumulating, unhedged S&P 500 ETF from a large provider with strong tracking is usually the best choice. Don't overthink the trading currency. Don't chase the lowest TER at all costs. And don't ignore taxes. The biggest mistake I see is investors spending weeks choosing between nearly identical ETFs, then selling them at the first drawdown. The ETF choice matters, but behavior matters more. If you found this breakdown useful and want more practical investing frameworks like this, don't forget to subscribe to the channel and also hit the like button to help the YouTube algorithm. See you next time.